Are we in stagflation? Right? Why do I say that? If you remember, GDP growth rate came in at 4.3%, the slowest since 2021. Then, surprise, surprise, inflation numbers came in at 6.1%. Economic slowdown plus high inflation. Are we in stagflation? Let's discuss. My name is Den Slim, and welcome to another episode of Monday Market Outlook. So on Thursday, inflation numbers came in at a surprise 6.1%, which was way hotter than the 5.3% last month. If we look at the breakdown, we've been tracking these factors for several episodes, and we were kind of expecting this. We've been worried about how rice prices, the peso weakness, and oil prices were going to affect our inflation numbers. The market overreacted to the news and went down heavily on Thursday. So, are we in stagflation? Let's look at some key data moving forward and see what the situation looks like in the coming months. Now, first, we have the World Bank coming out with GDP growth forecast for select Southeast Asian countries. The Philippines is expected to grow at around 5.6% this year and will improve to 5.8% next year. So far, it's not such a bad number compared to the East Asia average for next year, which is at 4.5%. So at least we can look forward to better growth numbers. Next, we have WTI crude prices with a heavy sell-off last week, hitting new lows, breaching the $84 support. After this, we are looking at $79.50 as our next demand zone. So things are definitely looking better in terms of fuel cost. On the dollar front, we are seeing a massive rally on the US 10-year, currently at 4.8, as well as the 20-year yields also at new highs, coming in at 5.17%. But the dollar finally showing some signs of weakness, but this could just be a mean reversion. And if it continues to hold above the 20 EMA, given the recent rally on the US yields, then 109 could actually be a possible target. But in the meantime, the peso has managed to hold its position well below the 57 threshold. Again, how long it can keep this up is anybody's guess. But let's hope for a dollar breakdown, which could ease some pressure on the peso and eventually on inflation. GDP growth rate seems to be okay. Oil prices are down. Global rice prices are actually down from their highs. The dollar is the only concern for now, but so far, the outlook looks much better than it was before. Is this stagflation? It's too early to panic. So let's look at the PSEI charts. The index reversed on Friday after an overreaction from surprise inflation numbers gave the bulls an opportunity to buy the dip. This puts us back to 6,250, which is now a resistance zone. So Monday's price action, when it opens soon, will set the tone for the week. Obviously, if it opens above 6,250, then we could see another rally towards 6,375. And if it moves to the downside, we can see the index retesting 6150. I'm more inclined to the upside given potentially easing inflation pressures. Also, if you think about it, 6.1% inflation was actually within analyst expectations. We were expecting 6.1 to 5.3%, which is why we think that the sell-off here was an overreaction. Now, let's look at some select stocks. We have Metrobank back at our 52 buy zone, but the chart is not looking good as we were unable to form a higher high here. So this suggests continued weakness, and if we look at this price channel here, this suggests that we can move to the downside. If we look at the longer term price channel here, it also points out to 51 being a zone where the bulls might potentially come in. So people have been asking me about the correction on Semirara last Wednesday and Thursday. Now, always check coal prices to get an idea for SCCs. So if we look at Newcastle coal futures, as fuel prices have gone down, alternative sources of energy tends to follow suit. So if we look at coal prices, this was a massive sell-off on Newcastle coal futures, which closely tracks why SEC went down the other days. No dividend announcement yet, but it should be soon. Who knows, maybe this week. People are also asking me if it's good time to buy. It's no longer a good time to buy. It's too late. People have also been asking if it's a good idea to buy now because the dividend announcement should be upcoming and sell after dividend X date. Please don't do that. Please don't do that. It doesn't work. What happens after X date? See the drawdown here? So whatever dividends you will get will be wiped out by the drawdown the next day when you try to sell. Doesn't make sense. Instead, if you were able to buy SEC on the dip after X date and sell now, this is already a 25% gain. Do that instead if you really want to trade SEC. As we discussed JFC and the potential ascending triangle, unfortunately, with this intense selling pressure here, this actually even looks like a straight line. Rallies tend to encounter sell demand. So this puts us on track for our 212 peso target. We've been trading Jollibee for 2 years along the 212-260 price zone. We have a tentative buy zone here at 225, and while yes, it did look like a good zone to enter, the drawdown here gives us an opportunity to buy Jollibee at 212. So hopefully we can see another 212-260 trade coming up. Now, URC's chart looking much better as we see some structure happening at the 119 level. Some good news for URC as the junk food tax bill was junked. So could this be a good time to enter? Is this accumulation or distribution? So let's check the oscillators. See how we have a positive divergence here. So my bet is for URC to move to the upside. On to the global markets. On Wednesday, Philippine time, the JOLTS numbers jolted the markets with a big drawdown as the labor market continued to show resilience. 9.6 million job openings compared to the 8.8 million estimate, again fueling the speculation for an end-of-the-year Fed rate hike. ADP numbers coming in way below expectations, 89,000 versus 160,000 expectations, only to be overshadowed the following day with more bad, well, it's actually good news, but more bad news with non-farm payrolls coming in at 336,000 jobs compared to the 170K estimate. Now, this is the largest monthly change since January. But the week ended on a positive note when the average hourly earnings came in way below expectations, signaling weaker inflation pressures for the US. So wage growth was 10 basis points below expectations and its downward trend continuing. So let's look at the S&P 500 charts. The S&P 500 ended the week on a high as we got back above this demand zone. Of course, after the overreaction to the JOLTS data, the market had some initial difficulties overcoming resistance here. So far, the 4,200 support held, and as we've said, the market should revert to the mean pretty soon. And if we turn on the moving averages, we may still have a bit of an upside in the next few days before testing the 4,350 resistance zone. So what do we have in the pipeline? Earnings season has started, and next week we will have food and banks reporting. This will give us some idea on consumer outlook as well as some economic outlooks when the banks start to report. Let's look at some charts here. We have the breadth chart here, the 50-day moving average breadth charts close to critical lows. This is a chart representing the percent of stocks above their 50-day moving average. And we are currently in a zone where we've seen previously marked some form of market bottom. Could we still go lower? Yes, we could still go lower, but we may be seeing a market bottom pretty soon. Let's go back to our seasonality chart. So far, we are currently here on the second dip. There's some form of consolidation here before the seasonal Q4 rally kicks in. If we zoom in to the October data, remember that this is a pre-election year, And if we look at the October price action, there's a bit of a difference between the pre-election years compared to normal years, as we see a much further dip before a rally happens towards the back end of October. So far, we are on track. For early October, we had a dip and a rally. Could we see a further dip in the coming weeks? Let's go back to the S&P 500 charts. We could be looking at the S&P 500 to move towards 4,350, test it, and we are anticipating an uptick on the CPI numbers given the oil rally last month, which could potentially push the markets back to this demand zone here at 4,280 or 4,260. So finally, we have the Philippine Stock Exchange with a rollout of short selling on October 23. So far, this will be available to select stocks and will be available to institutional as well as retail investors. It's too early to say what kind of effect this will have on the markets. But for one, we will most likely see better liquidity and higher trading volumes. This could also introduce additional risk management tools as well as earning capabilities, as investors with long positions can potentially lend their stocks to shorts for a fee. Could we see short squeezes also happening for the Philippine markets in the future? So we'll see. But for now, that's it for this week. If you found the information on this episode useful, please like this video, subscribe to the channel for more updates, and again, good luck on your trades. Please manage your risks accordingly, and I'll see you again next week. Bye-bye.